You cannot do velocity banking without positive cash flow. So we had to create a situation where we had to inject some cash to be able to create a positive cash flow situation, which required us to eliminate a retirement account to do so. Today we are going to rebuild the retirement with the fact that we've eliminated $51,000 of debt in less than 16 months. Just to remind everyone as to what velocity banking is, your money comes into your checking account, and from your checking account, that cash flow, all of that money, all of your check goes onto a debt tool. Once you put that money on that debt tool, it puts you in a position to now pay bills from the tool. And when you pay bills from the debt tool, all of your cash flow ends up living on the tool that you use to pay debt from. Now, the challenge is, okay, I can put my money in my checking account and I can identify a debt tool. The question is, hey, can I pay all my bills from it? And that can be a challenge, but ultimately that is the concept behind velocity banking. And with your cash flow living on your debt tool over time, it pays down the balance on that debt tool, which puts you in a much more positive cash flow position because you are in essence using the same dollar multiple times. I guess the big picture piece around velocity banking is getting multiple uses out of the same dollar. Because we've been conditioned to believe once dollar goes towards a bill, that's it. We have zero access to that dollar once it goes towards that bill. But using this process allows us to get multiple uses out of the same dollar, which allows us to attack multiple bills at the same time. Without going all the way through everything again, just wanted to kind of quickly recap what occurred. Again, at month 0, we took $20,500 that was sitting between a 401k and a couple of IRAs and withdrew all of the money from them. So at age 59, there's no penalty as a result of that withdrawal, but we absolutely have to pay tax on that $20,000. In paying taxes on that $20,000, there's about a $5,000 tax required to be paid at the end of the year. And then these IBC policies, there was a total of about maybe $8,000 between all of the IBC policies. To be able to attack the first bill, we ended up borrowing $5,000 from between those two policies. So between the $14,000 or $15,000 that was withdrawn out of the 401k after the penalty, we added another $5,000. So there was a total of about $20,000 available to us. And so we immediately had taken that $20,000 to pay off this Navy card. And it was this card at $520 a month and 18% interest that it made sense to get rid of because it gave us an influx of $520. In addition, we paused payments on the IBC policies and allowed us to get out of a negative cash flow position, which is what we were in when we started. And as a result, we did pause policies of about $1,871. The reason for pausing those policies is again, we were in a negative cash flow position at month 0. But the bottom line is within those first three or 4 months, we were able to address a large amount of the debt that was in play. And then from month 6 on, it was really about addressing one last credit card and reducing the amount of the balance that was accumulated on the lines of credit, because the lines of credit happen to be our debt tool. So once we put all of this debt onto this debt tool, then the last step was to eliminate that. Finally, we reintroduced those IBC premiums. And so the objective at that point was to become whole inside of the IBC policy. So that's ultimately how or what was done to, eliminate that $51,000 of debt.
Does eliminating the debt help this person?
Monthly income was about $53.42 monthly going into the debt tool. Okay. So based off after tax, the amount that was going into his checking account at month 1 of $53.42, based off that dollar amount, working backwards, $53.42 times 12 is about $60,000. You throw in 20% of taxes on top of that. I'd assess that the annual income for this gentleman was right around 100K, maybe 96, 97, 98, 100K a year. Okay. So if they're making 100K a year, I have to assume the objective is to retire with 100K a year. Meaning I don't want to retire with less than what I already have. So if they're making 6 figures, then the objective is to retire with 6 figures. So if I'm 59 years old, what do I need at retirement age in order to achieve a six-figure income? Well, if I'm going to retire at the standard 65, in order to have a six-figure income, I would need to have at least 2.5 million inside of my 401k in order to be able to retire with a six-figure income. Okay, so where do I get that from? If you were to go to Vanguard, Fidelity, Morgan Stanley, any of your traditional retirement institutions, they use this thing called the Trinity Study, and out of that became the 4% rule, which says this: the max you can take into retirement should be 4% of your nest egg. And that's so that you don't run out of money in retirement. So if 4% of your nest egg needs to be $100,000, 4% of 2.5 million is how you get $100,000 a year in income. So in order to achieve retirement at age 65 of $100,000 every year, you would need at least 2.5 million. Having $20,500 at age 59 is a long ways away from having 2.5 million by age 65. So what that means is 65 is not realistic. So you push that out to 72. Maybe you push that out to 75. Still, at age 59, we're talking another 14, 15 years to be able to achieve a $2.5 million nest egg inside of a traditional IRA. I think there were two of them, two traditional IRAs and a company 401k. That is a significant gap to fill using traditional retirement accounts. And so what we were able to do is I came up with 3 scenarios. There's probably a million scenarios, million different scenarios we can identify. And I think the other piece that I just want to note here is if the actual amount starting in month 0 inside of a retirement account for a 59-year-old is $20,000, what is a realistic, I'll call it, goal using the $20,000 that's available? Because I backed into that one as well. And here's what I mean. I had concluded, based off having $20,000 in a retirement account, that they're probably putting away somewhere around $500 a month. So if they're doing that, they're on path to achieving what by age 65 or 72 or 75? And that dollar amount is somewhere around maybe 450, maybe $500,000. And when you do the math on how much income is that, it's $20,000 a year in income. So the current retirement account, if we do nothing, if we did nothing with that 401k and allowed it to continue to build how it is, it would accumulate or achieve about $20,000 in income. Was the other part of this?
They would find that out at the end.
Right.
Yeah.
When it's too late.
That also may not be the case because you're subjected to market risk.
That's right.
That's the part that just is like, and then on top of that, taxes. You say it all the time. We don't know what we don't know. And so we continue on with the information that we do have, trying to do our best.
This also is not the fault of the person either, because there's conditioning here.
Right.
Meaning we've all been conditioned to believe a certain way about where we're supposed to put money and what that money is supposed to do for us over time and the position we're supposed to be placed in once that money matures.
Yeah.
And so the contributing to a retirement account when I am $50,000+, $80,000+ in debt, we've been conditioned to believe that's what we're supposed to do, right? When in fact, there's a whole lot of pieces and points here that need to be addressed before we basically putting ourselves in a much more positive cash flow position before we can take action, because all we're doing is robbing Peter to pay Paul. And you're right, the vehicles that are available to the average American to be able to prepare for retirement, those vehicles are flawed. And we're not taught about the flaws within those vehicles. And because the vehicles are flawed, it causes us to put money in a place where it doesn't serve us in the long run. It's kind of hard to focus on anything other than getting rid of bills when you're sitting here. When you're sitting here, okay, you've created some room. You've created some room between 0 and where you are as far as cash flow to be able to maybe interject some cash into a retirement plan or whatever the case may be. But when you start to eliminate that debt, it's game on. There were a few different scenarios that we came up with, and this is the first one. What if, instead of, once we eliminated that 401k and took that lump sum to be able to pay down that Navy card, and paused payments for 3 months, that gave us an influx of cash. And what if after those first 3 months, because during the first 3 months, again, if you remember, during the first 3 months, 1, 2, 3, during the first 3 months, we were able to eliminate some debt. So because we were able to eliminate some debt, there is an influx of cash. So as a result of there being an influx of cash, what if we took $500 and put it into a secure compound interest account? What would this look like if that was the case? Take $500, put it into a secure compound interest account, and allowed that to compound till age 72. Well, you would accumulate it right around $10,000 a year annually, tax-free for the rest of your life. So that $500 at age 59, that $500 till age 72 would allow you to achieve right around $10,000 tax-free. Well, once the debt was addressed, and that's kind of what this looks like from from month 3 till right around month 156, till age 62. So at this point, once all of this debt has been addressed, we have cash flow available to us to go do some things with. Well, because we have cash flow available to us, let's now be a bit more aggressive. And what is that cash flow we have? Well, once all of this debt is addressed, we now have paid back what we owed to both of these IBC policies, which means at a minimum, there should be somewhere between 30, I guess I need to come over here some. At a minimum, there should be somewhere between 35 and let's say maybe 45K available to be able to be used for something else. And so, which means we should have the ability to leverage a lump sum to be able to get that compounding. And so if we're able to do so from age 62 to age 72, so from age 62 to 72, there's about at least a minimum of $30,000 available, plus the 1871 that we're currently contributing to be able to start a secure compound interest account. So if we at a minimum start at $500 a month from age 59 to 72, plus this 1871 from age 62 to 72, what would that do? Well, inside a secure compound interest account, that would produce for us right around $42,000 tax-free for life. Okay, so what I was basically saying was at current age of 59, what we want to do is take, in 59 till 72, take $500 and start compounding, meaning we have depleted the original retirement account, so there's nothing in it. And now we're going to take $500 once that cash flow starts and start contributing. So $500 inside of a secure compound interest account, what would that do? Well, yeah. So that would allow for about 10K. Oh, of course I would. Hold on one moment. So that ends up being about 10K in income annually. That's this dollar amount. And it equates to about a nest egg or cash value of about 114K. So these are the $2 amounts. And maybe since I'm bouncing back and forth, you might want to show the full picture. Otherwise, you'll have to be swinging back and forth.
Yep. Got it.
I'll wait for you.
Boom. Done.
Perfect. So in essence, what I was saying was, so if you starting the account now, there's that $10,000 annually that's available to you. And that $500 a month equates to about 10,000. So there's your 10,000. And then starting at age 62, because you now have more cash flow available to you, we will then, from age 62, so once the debt has been paid down, not necessarily paid off, but paid down from age 62 to 72, you have available at least at minimum 30,000. There should be more, but I'm saying at minimum 30,000. And in addition, we're no longer paying the 1871 into these policies. What I'm saying is we're going to 1035 exchange and move that 1871 that we were paying from in those old policies over to a secure compound interest account, which equates to about $31,000. $31,000 31.5 maybe, $31,000 as in income annually and a nest egg of about 335,000. One other thing to note here, there's a death benefit associated with this as well. If something were to happen to him, he would be leaving his beneficiaries about 1.2 million. So in eliminating a 401k with that doesn't really have a true death benefit, and eliminating a 401k at month zero and taking two approaches, taking $500 and putting that away from age 59 to 72, and starting at age 62, putting away 1871 for the next 10 years, allowed us, in combination of these two actions, to achieve 42,000 tax-free for life. And in total, that death benefit would be somewhere around, because there's an additional 114,000, I think, which would equate to a total death benefit of around, let's call it about 1.3 million in death benefit between these two policies. And again, so show me the 401k that could come close to any of that.
Yeah, and in order for you to be able to opt in for a life insurance policy, you'd be splitting up your funds so it would have less impact
Right.
for you. Yeah.
And in addition, I think you bring up something that's important as well. You can't just haphazardly shut down your 401k and jump right into a secure compound interest account. But there are some actions here that were already in play, which tells me this person can absolutely do it. They already have two IBC policies, which means at age 59, they've already been approved for life insurance, which means they have a certain amount of, I'll call it insurable interest available or insurability available. So what we're doing is taking advantage of that insurability they already have. So they already have two policies worth in total, probably $200,000-$300,000. And all we're doing is moving those two policies that they've already been approved for into a secure compound interest account. That's a penalty-free, tax-free transfer as well. So because we're just simply moving the two policies they had into this, there's not additional actions involved. And again, things can change between age 59 and 62, so health can change. But because we're moving these permanent policies over, there's no, I'll call it, there's no reevaluation of health that would be required, because we're taking policies that already existed and moving them into a secure compound interest account, if that makes sense.
But look what you've done already. Just in the first option, what you had just laid out for us before was that the best case scenario was that this person was set up to get 20,000 a year.
Right.
But that's going to be taxed on top of that. And now in the same amount of time, just by restructuring differently, again, the power of information. That's right. This person is now able to at least not just double what it is that they'll be able to get per year, but in addition to that, now they have also leverage in the cash value part of this policy and the death benefit.
And don't forget, that's $42,000 a year plus Social Security. So again, I don't think I'm hitting anywhere close to that $100,000 a year that we would like, but we are 50% greater, 50% more than what it seemed as though would originally be there if they were using the standard retirement account that was available.
Probably more because of the taxes.
Right. And so the second option, let's see here. The second option that I identified was, okay, instead of, and this is somewhat unique as well, because words matter. Instead of starting at month zero, what we're going to do is surrender the IBC policies. So there's a lot here. So what do I mean? So for that, I want to come over here. Let's talk about these policies a little bit. I've got a $6,600 balance on this Penn Mutual and a $22,000, almost $23,000 balance on the Security Mutual. And these balances are loans, meaning this is about $30K due. And these monthly payments of $371 and $1,500 are not making a dent in that $30,000, meaning these are just the premiums due on the policies. There is nothing extra or additional. If you're only paying these premiums, that does not pay the balance that's due on those loans. So the thought process was, what if instead of addressing the $30,000 that was due, we just surrendered the policy? What that means is we're canceling. We're letting the policy lapse. We're not going to, and I'm not suggesting this. I'm just saying, what if we no longer make another monthly contribution and we let that policy lapse? That means all of those 1871s a month that was done in the years prior, we lose. Like it's a waste. There's no death benefit left. We surrender the policies. Well, what happens if you surrender a policy? Well, the IRS is going to come along and say you will lose all of the tax advantages associated with those policies. So therefore, they're going to say that $30,000 that you still owe, that's now becoming a taxable event. Well, it's not all a taxable event, because the money you've used to contribute to this policy, a certain amount of that you've already paid tax on. So there is a difference between the amount that you've put in and the amount that you have left over, the amount that you owe, that you're going to owe taxes on. And I'd assess that amount at being about, let's call it $7K. So there's about a $7K tax liability associated with surrendering these two policies. But if the two policies are surrendered, what does that mean? Well, if you surrender these two policies, meaning you cancel these two policies, there's $1,871 a month that is now available. There's $1,871 a month in cash flow that you can now use to go eliminate debt. As I kind of mentioned a couple days ago when we started this example, what you're going to hear from me are non-traditional approaches. This is a non-traditional approach to attacking debt. So, coming back over here. So in doing so, starting at age 59, starting at age, which is month zero, starting at month zero, we're going to surrender that $30,000 balance that we owe on those two IBC policies, which is going to cause a taxable event. And then in addition, starting in month zero, we're going to then take that 1871, and for the first year, so from age 59 to age 60, so from age 59 to age 60, right about here, so from here to here, we're going to use that 1871 to attack this debt. And then at age 60, we're going to take that 1871, so we're going to give it a year. We're going to take that 1871 plus the $500 that we are no longer putting in our 401k, meaning this option assumes we did everything else from option one, everything else from the original attacking of debt, the depleting of the 401k, we did all of that the same. The step that's different here is instead of pausing payments for 3 months on the IBC policies, we just let them surrender. So if we did everything else the same, surrendered the policies, took the monthly payments from those policies plus what was going into the 401k, and at age 60 started a secure compound interest account, what would happen? Well, the debt payoff, instead of it being 16 months like it was in the original example, it becomes 19 months. So it takes us an additional 4 months to get rid of that $51,000 in debt. That's the biggest change here. But after that, everything else is going towards income. Everything else is building a retirement. And so you take that 1871 plus 500, dump it into a secure compound interest account, and let's see what happens. And so from there, let's jump into this calculator and let me show you what I mean. So again, we didn't do anything at age 59. We started at age 60. At age 60 till age 72, there's no lump sum. There's no lump sum available because we surrendered the policy. So there's no lump sum there to even have access to. We took all the monthly payments, 1871, plus that 500. So 500 plus 1871 would give us a total of 2371. So at minimum, we're taking, I think the cash flow shift was about a $4,000 cash flow shift. So what we're saying is we're taking a little bit more than half that cash flow starting at age 60 and dumping it into a secure compound interest account. So if we take that 2371 and do so, what happens? Well, By age 72, we're talking about an income of about $41,000 tax-free, 41.5. We're talking about cash value of about $480,000, almost $500,000 of cash value available. And again, God forbid something were to happen to him, we're talking about a death benefit. We're talking about a death benefit of about $1.3 million. Again, had he done nothing and just continued his normal path, show me a 401k that can accomplish any of that. It's just not going to happen. And so again, from age 60 to age 72, putting away $2371 monthly would allow inside of a secure compound interest account. And we can dig into why a secure compound interest account does what it does, but just taking this for face value that these are facts, you would be able to achieve about $41,000 tax free and a nest egg of about $480,000. About 480,000 in cash value. So cash value about 480K and a death benefit of about 1.3. So again, the first approach was we are taking some small action at month one, using about $500 a month to get started, then pay down some bills. And then by age 62, we're going to hit this thing hard. In the second example, it was, okay, maybe we don't start a secure compound interest up front, but we take a drastic measure to not only eliminate the retirement account, but we're going to take a drastic measure to eliminate the bill associated with the life insurance as well. So we're going to surrender the policy, pay whatever the negative impact is from doing so, but that frees up cash flow for us to attack debt aggressively. And then at the end of the first year, so after 12 months of doing so, we immediately jump into a secure compound interest account, and we're still able to build somewhere around that same, I'll call it $40,000 a year. Again, using this same example inside of an IUL would probably somewhere around $20,000 a year in income, meaning comparable to what you could do with your 401k. But when you add leverage, it allows for that income to double, which means it's why it's showing more like $40,000 inside of a product like MPI. What is this about?
Yeah.
This is about taking control. And that means it's about getting self-directed. What are those vehicles, those tools you're using to generate wealth? And in the process of generating wealth, what you're also doing is you're gaining more control over your time. If you were to look in the mirror, who right now controls your time? Who tells you when you can or can't take off? And then the last part is freedom. Putting yourself in a position to where you can actually have true freedom. And freedom is a very, very simple, there's a very simple definition around freedom. It's being able to do what you want, when you want, with who you want, whenever you want. It's about control.
How do I become self-directed? Like, how do I get on board with this movement?
It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get self-directed.